Las Vegas, 1978. In a back hallway at the Stardust, a counting room clerk zips a canvas bag of cash into a courier's trunk. The car slips north on I-15 before dawn, neon shrinking in the rear view. By midday, the same bills will be cashier's checks. By week's end, they will finance a car lot, a trucking company, a nominally legitimate restaurant. This single night reveals the mob's real invention, a system that converts illicit cash into lawful capital. They did not only take, they engineered. They turned stolen currency into bankable assets, reputations, and empires. Cash was the raw material. Couriers moved it. Counting rooms isolated it. Front businesses absorbed it. Paper companies hid it. Offshore banks sheltered it. Trade invoices disguised it. Pension funds invested it. Stock markets laundered it. Each method was a link in a chain built to erase origin. Skimming in casino counting rooms removed millions before audits. Shell corporations created false revenue to justify transfers. Numbered accounts in secrecy jurisdictions funneled funds beyond U.S. reach. Trade-based schemes hid value inside legitimate goods. Union pension loans supplied vast lawful capital. Real estate turned cash into durable wealth. Market manipulation and boiler room brokerages made illicit profits appear as investment returns. The mob's approach was practical, iterative, and adaptive. When one corridor tightened, they opened another. They recruited fixers, lawyers, accountants, bankers, who masked ownership and designed the paperwork. They exploited regulatory blind spots and the slow pace of international cooperation. Follow the cash, and the pattern appears. Not random theft, but financial engineering. This documentary will trace 8 laundering methods, from couriers to corporate raiders, and show how criminal proceeds were made to look legitimate, generation after generation. Follow the cash. The money tells the true story. June 4, 1955. A courier closes the trunk of a rented Cadillac and checks the straps on a single canvas bag heavy with bills. That bag is the raw problem. Cash is immediate, anonymous, portable, and incriminating. Criminal enterprises can produce cash faster than they can invent explanations for it. Hide the origin, and the cash becomes the building block of a covert economy. Cash is the foundational problem because it speaks without paperwork. A $20 bill cannot answer where it came from. A bank deposit requires a name, an account, and questions. So the first task of any laundering operation is simple. Move the cash away from the point of crime and into a space where it can be redefined. The simplest tactic is movement. Courier networks carried physical currency from gaming cages, backroom tills, and prostitution rackets to centralized processing points. Those couriers were not uniform. Some were trusted employees, others low-risk locals, and some were veterans of the street who knew how to vanish. Their tradecraft was logistical, not glamorous. Timing, route selection, vehicle concealment, and dead drops. Transit concealment used cheap engineering. False bottoms in trunks, hollowed suitcases, laundry carts, and armored vehicle facades disguised by legitimate company livery turned ordinary conveyances into vaults. Couriers learned to avoid predictable patterns. No same motel, no same bridge, no same toll booth sequence, because patterns create investigators. Routes shifted seasonally, and couriers rotated hands at prearranged stops to defeat witness recall. When banks became inconvenient, smurfing filled the gap. Large amounts were broken into many small deposits below reporting thresholds and spread across dozens of accounts and branches. This required coordination. Multiple depositors, phony payees, and front employees with clean records. Each deposit looked legal. Together they aggregated into substantial sums that could be wired, invested, or converted into cashier's checks. Mid-century mob operations relied on these techniques to move revenue from cash-heavy vices to family headquarters. Nightclub receipts, slot machine takings, and extorted payments were collected, bagged, and forwarded along courier lines that connected cities. Las Vegas to Los Angeles to Miami, Miami to New York, and crucially, Las Vegas to Chicago. Physical cash moved along interstate arteries long before digital surveillance made such travel conspicuous. Tools and limitations defined both sides. Before 1970, banks lacked the legal obligation to report large cash transactions the way they do now. Congress closed that gap with the Bank Secrecy Act on November 26, 1970, creating currency transaction reports, CTRs, to record deposits over a statutory threshold. Prior to that, tracing a bag of bills required witnesses, informants, or luck. Armored car services offered security but left paper trails and corporate exposure. Private couriers offered discretion at the cost of vulnerability. A concrete case study: casino cash couriers. Counting rooms separated casino cash into official channels and off-the-books amounts. A portion, the skim, never entered formal accounting. That cash required physical movement to laundering nodes. Courier operations established scheduled pickups at back doors, disguised as linen deliveries or vendor service runs. Drivers used legitimate-looking cover companies to rent vehicles, buy fuel, and provide maintenance receipts that obscured travel. A successful transfer could move hundreds of thousands in a night. A single compromised hand could collapse months of secrecy. Why were these routes so hard to trace? Because in the pre-BSA era, investigators could not subpoena electronic records that didn't exist. License plates and motel receipts were ephemeral. Cash leaves no emails. Only human intelligence, wiretaps, informants, and surveillance could reconstruct a money route. And human intelligence costs time and risk. Informants flip, wiretaps pick up slang instead of names, and surveillance requires presence without discovery. Law enforcement adapted. The FBI and local police increased vehicle surveillance, conducted stakeouts of known courier hotels, and built link charts from motel receipts, fuel purchases, and rental contracts. They used traffic stops not solely to arrest drivers, but to check for inconsistencies, mismatched IDs, transient lodging patterns, and odd maintenance records. Undercover agents posed as drivers and vendors to penetrate routines. Policy tools followed the tactics. The Bank Secrecy Act and CTRs forced banks to log large cash deposits, turning deposit behavior into evidence. Later regulatory layers, know your customer rules and suspicious activity reporting, made repeated small deposits and depositor networks visible. Where once a courier could deposit thousands in cash across branches without raising alarms, banking reforms created flags that linked patterns together. Even then, cash movement persisted by adaptation. Couriers diversified, more hands, smaller loads, coordinated deposits timed to avoid branch overlap. They added financial layering, converting cash to cashier's checks at different banks, buying negotiable instruments, and reinvesting in cash-intensive businesses that could justify high receipts. They exploited institutional blind spots, branches with lax oversight, rural banks with limited AML controls, and physical infrastructure that impatient prosecutors could not always map. The tug-of-war remained practical. Operational ingenuity versus institutional oversight. Couriers succeeded when they made money look ordinary. Law enforcement succeeded when it forced money to speak on paper. Follow enough suitcases and receipts, and the pattern emerges: routes, recurring aliases, and the small errors that collapse secrecy. Cash was the first firewall for organized crime. Breaking that firewall required changing law, technology, and investigative tradecraft. And when the legal tools tightened, laundering strategies shifted to the next layer: shells, banks, and offshore havens, each one an attempt to buy distance between a bill and a confession. Chapter 2. Casinos and Skimming. The washing machine on the strip. Skimming is simple in concept and devastating in effect. Remove cash before it ever appears in the casino's official books. Skim a little every night, and over months and years you manufacture millions of unrecorded dollars. Those dollars never see a ledger, never face taxation, and never require an explanation. The technical heart of the scheme was the counting room. After a night of play, coin and currency from slot machines and table games flowed to cages and pits, then to armored carts, then to a locked counting room staffed in shifts. Counting room clerks reconciled coin drops, stacked currency into bundles, and prepared official deposits for the bank. The official process created one record. The illicit process created another. Collusion made the difference. A complicit shift supervisor could divert a portion of the cash before it was logged. A counting room employee might underreport a tray, pocket the difference, and swap tags. Managers who agreed to look away provided plausible cover. Inspections passed, auditors reassured, and regulators placated. The more people who touched the process, the cashier, the pit boss, the comptroller, the more opportunities there were to falsify a story that matched the ledgers. Operational controls were bypassed with methods both low and high-tech. Night by night, staff rotated shifts to prevent pattern detection. Small teams specialized in manipulation of drop boxes, altering timestamps, or delaying counts until cover stories could be prepared. Bins would be resealed, seals recorded inaccurately, and official reports adjusted the next morning to match expected numbers. A nominal discrepancy here and there became routine. Las Vegas from the 1950s into the 1980s provided the environment that made skimming practical. Casinos handled vast sums of cash with daily volatility. Audits were periodic and often superficial, and regulatory oversight evolved slowly as the city grew faster than oversight systems. The physical distance between counting rooms and boardrooms, and the informal networks that ran between them, allowed money to be siphoned discreetly. Organizational structure mattered. Skimming required insiders, trusted casino personnel, sometimes front company managers, sometimes external fixers, working with contacts in other cities who could receive cash or convert it to negotiable instruments. Front companies rented office space, provided receipts, and bought trucks and equipment to justify cash flow. Nominees and straw owners concealed the beneficial owners of properties and businesses that later received skimmed funds as investments. Several real people and institutions became emblematic of that era's dynamics. Managers with criminal ties sometimes operated in managerial roles without formal gaming licenses. This lack of licensing scrutiny was a vulnerability exploited by organized crime. Casino properties, names that included the Stardust, the Fremont, and others, became nodes in networks that routed cash off the books and toward Midwest families. Frank "Lefty" Rosenthal is a documented example of a manager who controlled operations across multiple properties and whose associations with mob-linked interests led to regulatory action and later revocation of his gaming privileges. A nightly skim unfolded like a factory shift. At closing, cash moved from machines to pit to count. Some trays were declared short, others were counted twice. A clerk bagged the skim in plain canvas. A vendor cartwheel clanged as it rolled the bag to the service entrance. A courier, listed as a linen driver or maintenance contractor on the manifest, picked up the bag and drove it to a prearranged transfer point. There, cash was pooled with other nights' takings, separated into courier loads, and routed toward laundering nodes, bankers, front businesses, or direct couriers heading to family headquarters. Pooling reduced risk and normalized variance. One night's skim might be trivial. The pooled weekly sum justified a courier run, a wire transfer disguised as a loan repayment, or a silent investment in a newly formed company. Convert the cash into cashier's checks, register a shell company as a vendor, and the money gains plausibility. Once invested in legitimate assets, the funds achieved permanence and public respectability. Weaknesses in oversight sustained the practice. Early Nevada regulation lacked the real-time accounting and forensic auditing that later decades would demand. Audits were typically periodic. Internal controls were often inadequate for the scale of cash handled nightly, and industry insiders sometimes resisted intrusive probes that would reveal embarrassing vulnerabilities. Cash is fungible. When oversight is slow, fungibility becomes opacity. Law enforcement responses evolved from suspicion to strategy. Initial investigations relied on informants, employees who turned state's evidence, and on painstaking ledger comparisons. As the patterns emerged, the FBI wired motel rooms, counted room offices, and social clubs. Operation Strawman, a federal probe beginning in the late 1970s and into the 1980s, targeted precisely the counting room networks and courier flows that sustained skims. Wiretaps captured conversations about nightly counts, about which manager would take care of a discrepancy, and about planned courier movements. Prosecutions followed when wiretaps met paper trails. Collectors, couriers, counting room clerks, and a handful of managers were indicted for racketeering, tax evasion, and conspiracy. Convictions disrupted routines. but they could not immediately erase decades of embedded practices. Skimming adapted, more clever seals, more layered corporate entities, and deeper use of offshore intermediaries to receive funds. The legal clampdown forced a structural change in how illicit proceeds were handled. As counting rooms came under scrutiny, organized crime increased the use of front businesses and offshore accounts to launder proceeds further from the casino floor. But the counting room remained the original washing machine, where illegal cash was first separated from the legitimate operation. Where the first cut was made, investigators found the clearest forensic traces: misplaced tags, anomalous shift logs, and the human conversations on tapes that confirmed what the ledgers hid. Skimming, in its simplest form, exposed a fundamental truth. Where there is a concentrated flow of unmonitored cash, there is opportunity for concealment. The Las Vegas skims taught law enforcement how to listen for money, how to follow the rhythm of shifts, the cadence of audits, and the human signals that betray collusion. Break the pattern at the counting room, and you begin to dismantle the washing machine on the strip. Chapter 3. Shell corporations and front companies. Paper that cleans cash. Shell corporations are paper masks. They look like businesses on the surface: letterhead, an address, an employer identification number. But behind that facade, there is often no economic activity, only a ledger entry designed to change the character of money. The methodology is straightforward and methodical. Create an entity with no real operations. Place a nominee director or shareholder in the public records, someone whose name appears on filings, but who holds no beneficial interest. Open bank accounts in the company's name. Then route illicit cash into that account as a loan, consulting fee, or investment. Once the money sits on a corporate balance sheet, it can be transferred, invested, or used to buy assets that appear to come from legitimate corporate earnings. Shells were critical because they turned cold currency, canvas bags, suitcases, courier trunks, into accounting entries. Accounting entries can be audited, explained, and presented to banks and regulators. The mob's basic question was always, how do we convert unaccounted cash into documented capital? Shell corporations provided the answer. Practical mechanics relied on jurisdictional gaps and professional intermediaries. In the mid-20th century, incorporation could be inexpensive and anonymous in many places. Within the United States, states like Delaware provided corporate privacy and flexible corporate law. Offshore havens, Panama, the Bahamas, certain Caribbean and Swiss structures, offered even more secrecy. Nominee shareholders and directors shielded beneficial owners. Bearer shares, where permitted, removed the need to list owners at all. Operationally, the process had several discrete steps. First, an apparent need for funds was created on paper. A new company needed startup capital. A consulting contract was proposed. A vendor supplied services. Second, cash, often couriered from a casino skim, was deposited into the shell's bank account and recorded as a loan or a payment under that contract. Third, the shell paid a supposedly legitimate recipient, another corporate entity, a real estate escrow, or a financier, often in the form of cashier's checks or wire transfers that left a paper trail inconsistent with a suitcase of bills. Fourth, assets were purchased in the shell's name: a car dealership, a commercial building, a trucking fleet, or minority stakes in hotels. Finally, funds appeared on other ledgers as dividends, loan repayments, or profits from an opaque business, making them look legal. Local front businesses played a central role in this architecture. Restaurants, vending companies, parking operators, and trucking firms historically accepted large amounts of cash while offering plausible explanations for high receipts. A restaurant with inflated daily takings could legitimately deposit large sums of cash. Those deposits became the source for wire transfers, payroll, and supplier payments. Vending companies and jukebox operators, with cash collections across multiple locations, provided convenient cover for pooling money in a corporate account without scrutiny. Corporate fronts were also used to acquire property and, at times, casino interests. Layered ownership concealed who controlled a title. A hotel might be purchased by a holding company, which was owned by another holding company, which in turn was nominally owned by a trust whose trustees were nominal. To an outsider, the chain looked like legitimate corporate structuring. To investigators, It looked like an onion hiding a single beneficial owner at the center. Finance details explain why this looks clean on paper. When illicit proceeds are recorded as a loan on a company balance sheet, the company appears to have legitimate financing. That loan can be repaid later with apparent profits, or the company can declare dividends that transfer cash to the true owner in ways that resemble normal corporate finance. Even better for the launderer, the shell can issue invoices to justify transfers between corporate entities, consulting fees, intercompany charges, or management fees that make cash movement routine and unremarkable. Those tactics had vulnerabilities, however. They depended on willing professionals, lawyers willing to set up structures, accountants willing to sign off on paperwork, and bankers willing to open accounts without demanding unacceptable levels of due diligence. Paper trails depended on consistent, plausible documentation, contracts, invoices, payroll records. If an auditor or investigator demanded supporting documents that could not be produced, the facade collapsed. Historically, organized crime used this playbook repeatedly. Meyer Lansky and his associates in the mid-20th century used front companies and offshore entities to conceal investments in hotels and gambling operations from Havana to Nassau. In Las Vegas, the movement of skimmed cash was often routed through companies and distributors that, on paper, paid legitimate fees or loans to holding entities before funds moved on to Midwest beneficiaries. Union pension loans, marketed as legitimate investments in development projects, also inserted criminally derived capital into corporate balance sheets, which then circulated through real estate and hospitality sectors. Investigators countered paper camouflage with paper-based forensics. Subpoenas demanded incorporation documents, minutes, bank statements, and correspondent banking records. Forensic accountants compared declared revenues to industry norms. They examined vendor contracts for real substance and cross-checked vendor payments with physical operations. A trucking company without trucks, a restaurant without suppliers, or invoices for services never delivered became telltale signs. Prosecutions emerged when auditors and wiretaps intersected. A wiretap might capture a conversation describing a loan to a nominal company. A subpoena produced the shell's bank records showing rapid deposits and transfers. An informant explained the courier network that fed the shell. Operation Strawman and later federal cases used this combination, financial forensics plus human intelligence, to pierce shells that had long concealed illicit flows. Reforms followed. Enhanced due diligence requirements, suspicious activity reporting, and later beneficial ownership transparency efforts raised the bar for anonymous incorporation and anonymous banking. Courts increasingly permitted piercing the corporate veil where evidence showed the corporation was a fraud or alter ego. International cooperation improved the ability to obtain offshore records that once seemed beyond reach. Yet shells persist because corporate form is a legitimate tool of commerce. The same entity that cleans blood money can legitimately hold a family business, a non-profit, or a venture fund. That dual nature is the laundering problem. Legitimate law provides the very instruments criminals exploit. Understanding the mechanics, who signs a document, who sits as director, which account receives a deposit, often yields the answer. Follow the paper, cross-check the people, and the shell dissolves. But doing so requires time, legal authority, and cooperation across borders. And for decades, until reforms and prosecutions caught up, shells were the mob's most elegant instrument for converting dirty cash into the appearance of lawful wealth. Chapter 4. Offshore Banking and Numbered Accounts. The Global Cloak Havana. A conference room filled with men in suits and hat brims casts a long shadow over the future of organized crime. The Havana Conference was not a social club. It was a planning table for transnational opportunity, where mob figures discussed hotels, casinos, and, crucially, money. One lesson emerged clearly. Borders and banks could be turned into shields. Secrecy jurisdictions answered the call. Switzerland's private banking tradition, Panama's permissive incorporation rules, and the Bahamas and Caribbean islands' lax reporting regimes created an architectural cloak for cash. These places offered something simple and powerful: distance. The tools were legal in form and opaque in practice. Numbered accounts let a bank identify a client by number rather than name. Bearer instruments. bonds or shares payable to whoever held the document, transferred value without registry. Offshore trusts and foundations promised beneficiary protection under foreign law. Correspondent banking knitted distant banks together, letting money hop from one jurisdiction to another on letters of credit and interbank transfers that masked origin. Mechanically, the laundering logic was layering. Dirty cash, physical and immediate, was converted into a negotiable instrument or deposited, sometimes through a surrogate, into an offshore account. From there, funds moved through a chain. Intermediary accounts, shell corporations, trust vehicles, then back as investment income or loans to onshore enterprises. Each hop added paperwork. Each institutional hand obscured the first dirty touch. Practitioners exploited gaps in the banking architecture. Before SWIFT's ubiquity in the 1980s, international transfers were slow and arcane, routed by manual telex and correspondent ledgers. That opacity helped disguise chains of transfers. Even as electronic messaging arrived, many secrecy jurisdictions resisted sharing client lists. Swiss bank secrecy law, for decades, made disclosure extraordinarily difficult without domestic criminal charges. The Havana to Nassau axis was emblematic. Investments in Cuban and Bahamian casinos pre-Castro and post-Castro created structures where profits could be repurposed across borders. When regimes changed or scrutiny increased, the money moved to new havens: Panama incorporations, Caribbean trusts, Swiss custodial accounts. The physical geography of the Caribbean, with short shipping lanes and friendly incorporation rules, was ideal for quick repositioning. Numbered accounts and bearer bonds were not esoteric curiosities. They were practical instruments used routinely. A numbered account required only a code and signature stamp. A bearer bond could be cashed by the holder. In combination, they allowed a single bearer to carry millions without a name attached, portable value that looked like legitimate financial paper. Case studies of documented practice illuminate the mechanics without sensationalizing. Investigations in the 1970s and 1980s found that funds traced from gambling operations often terminated in offshore accounts before reappearing as corporate loans or investments. In later decades, when prosecutors obtained court orders, Swiss and Caribbean bank ledgers showed transfers from anonymous accounts into nominee company accounts, and from there into U.S.-registered corporations. Those ledgers, once beyond reach, became crucial evidence when mutual legal assistance and subpoena powers improved. The limits of the cloak were technical and political. As SWIFT standardized bank messaging after 1973, the speed and traceability of transfers increased. Good for commerce, awkward for secrecy. In response, secrecy jurisdictions and facilitators adapted. More layering, more use of correspondent relationships, more reliance on nominee directors and complex trust arrangements to hide beneficial ownership. Law enforcement adapted too, but more slowly. The Bank Secrecy Act, 1970, and later anti-money laundering laws forced banks to keep records and file currency transaction reports, but these were initially domestic tools. Cross-border cooperation lagged. Investigators needed two things: foreign records and permission to use them. Mutual legal assistance treaties, MLATs, provided a process, but they were bureaucratic and slow in practice, often taking years to produce ledgers that criminals could move on in weeks. The Financial Action Task Force, founded in 1989, shifted the landscape. FATF's recommendations pushed countries to adopt standards for customer due diligence, suspicious activity reporting, and information exchange. Switzerland, the Bahamas, and others slowly curbed the most blatant anonymity tools. Bearer instruments were restricted or made reportable. Banks increased know-your-customer measures. The legal and diplomatic climate began to erode the previously comfortable havens. Technology and strategy then co-evolved. Investigators combined traditional human intelligence, informants, courier flips, and wiretaps with financial forensics, tracing correspondent bank entries, matching MT-103 SWIFT messages, and reconstructing chains of transfers. When prosecutors secured MLAT responses, offshore ledgers revealed nominee names and correspondent entries that connected anonymous accounts to real people. Seized bank records from court-authorized disclosures provided the missing link between corporate shells and offshore custodial accounts. Still, vulnerabilities remained. Professional facilitators, bankers, lawyers, and trust officers often stood between investigators and the true owners. Nominee arrangements and trust laws in some jurisdictions limited direct disclosure to foreign prosecutors. And where political will was weak, records remained sealed. The true historical lesson is adaptation. As jurisdictions tightened, money routes shifted. Offshore flows moved to newer corners, to lesser-known registries, to private banking desks in otherwise reputable financial centers. Criminals sought layers, anonymity, and plausible commercial rationales. Regulators chased transparency, cooperation, and standardized reporting. Each measure forced a move. Each move required new expertise. By the 1990s and into the 2000s, the global cloak frayed. High-profile prosecutions in Europe and the United States began to compel Swiss and Caribbean banks to produce evidence. Banks faced fines, regulations stiffened, and bearer instruments lost much of their game-changing utility. But for decades, numbered accounts and offshore trusts allowed criminal proceeds to vanish into ledgers and reappear as clean capital, investments, loans, or acquisitions that no longer bore the scent of cash. Offshore banking did not invent laundering. It perfected distance. It turned domestic crime into a transnational bookkeeping problem. Breaking that problem required not just investigators but treaties, technology, and political consensus. And when those tools arrived, they did not erase the history of secrecy. They only made it harder to hide. Chapter 5. Trade-based laundering. Hiding value in plain cargo. Trade is trust writ large. Customs officers assume commerce is legitimate. Banks assume shipping documents match invoices. Insurers assume bills of lading reflect reality. Criminals exploited those assumptions. Trade-based money laundering hides value inside ordinary shipments. The basic techniques are methodical: over-invoicing, under-invoicing, multiple invoicing, phantom shipments, and misclassification. Each technique alters a number on paper so that money can travel under the cover of legitimate trade. Over-invoicing sends too high a value on an import invoice, so excess payment moves across borders as a trade payment. The importer declares a $1 million purchase when the cargo's real market value is $200,000. The extra $800,000 is effectively transferred under commercial cover. Under-invoicing flips the effect. Value is under-declared, so that the seller in a high-risk jurisdiction keeps the surplus outside normal channels. Multiple invoicing creates multiple bills of lading and invoices for the same shipment, so several parties can claim payment. Phantom shipments list goods that never exist. Funds move without cargo ever crossing a dock. The why is practical. Commodities have variable prices, subjective grades, and freight costs, which provide plausible explanations for price differences. A pallet of used clothing, a cargo of scrap metal, a container of seafood, each can legitimately vary widely in declared value. Those industries rely heavily on cash or informal credit, and their supply chains crisscross small ports with light oversight. Mechanically, the system leans on documents. A bill of lading is proof of cargo and title. A customs declaration states quantity and value. A commercial invoice lists price and terms. A letter of credit is the bank's promise to pay. Alter any of these and you alter the financial reality. An exporter in country A issues a commercial invoice at an inflated rate to a shell importer in country B. The importer's bank pays on the face of the invoice, moving large sums internationally. The cargo may be real, but the value recorded is false. The funds land in offshore accounts, then repatriate as investment returns, loan repayments, or supplier fees that now appear legitimate. Routing multiplies opacity. Shipments can transit multiple ports, change containers, or be consolidated with other consignments. Each handoff produces paperwork, and each paperwork note offers an opportunity to insert false information. Rerouting through neutral ports breaks direct audit trails. Transshipment through free trade zones allows containers to be relabeled or merged with legitimate goods. Container-level forensic inspection is costly and slow. Customs agencies often lack the resources to inspect a significant percentage of cargo. Shell importers serve as the onshore face. They incorporate for a few $100s, lease a small office, open bank accounts, and hire a nominal bookkeeper. Their registered activity justifies payments and receipts on paper. An investigator sees a legitimate company issuing invoices and receiving payments. The commerce appears normal until you ask uncomfortable questions. Where is the factory? Where are the payroll records? Why are all payments routed to an offshore correspondent bank? Historical practice shows how flexible this method is. After World War II, when global trade expanded and new developing economies grew reliant on commodity exports, criminal actors moved into import-export businesses to absorb cash and produce plausible invoices. Industries with high price variance, textiles, seafood, jewelry, scrap metal, were especially useful. A fishing company could report a higher grade of catch. A textile importer could claim premium fabrics. Scrap dealers could overstate tonnage and price per ton. The complex, fragmented nature of these markets made anomalies harder to detect. Technical manipulation is specific. A letter of credit issued by Bank X will pay on presentation of a bill of lading and commercial invoice. If the bill of lading is forged or the invoice inflated, the bank pays, and money crosses borders under the guise of secured trade. Banks rely on documentary compliance. They don't inspect cargo. Customs relies on declared data. Inspectors cannot open every container. Insurance firms accept claims based on paperwork. Each institutional assumption is a seam criminals can pick. Investigative friction is real. Trade records are distributed across agencies and companies, port authorities, shipping lines, freight forwarders, customs, banks, insurers. Reconciling these datasets requires cooperation among customs agencies, several countries apart, access to corporate records in secrecy jurisdictions, and the technical expertise to benchmark prices. Price benchmarking means comparing declared values to contemporaneous market rates, factoring in grade, freight, and insurance. That requires commodity specialists and historical price data, resources costly for overstretched customs offices. Because of cross-border complexity, effective probes demand international cooperation. Joint Customs FBI task forces emerged in response to sophisticated trade laundering. These teams combined customs intelligence on suspicious cargo patterns with financial investigators tracing correspondent banking flows. Forensic accountants examined invoices and payment chains. Trade analysts flagged abnormal pricing and routing patterns. Casework illustrates the technique without sensationalism. Investigators identified networks that used multiple invoicing to extract capital from one export. They discovered shell importers that consistently declared goods at values 10 times market rates and routed payments to offshore trusts. In other probes, freight forwarders cooperated after subpoena, producing bills of lading, showing empty containers reused to support phantom shipments. These documentary contradictions, double assigned bills, inconsistent container numbers, invoices with no supporting warehouse receipts, formed the backbone of successful prosecutions. Regulatory reforms followed. Customs authorities adopted risk-based targeting, focusing inspections on high anomaly shipments and high-risk trade lanes. Financial institutions increased due diligence on trade finance instruments. Banks began requiring more substantive documentary evidence and greater scrutiny of letters of credit tied to atypical counterparties. International bodies like the Financial Action Task Force urged states to develop trade monitoring capabilities and to share intelligence on suspicious trade. Technology helped investigators. Data analytics cross-referenced bills of lading, shipment manifests, and payment records to flag improbable value ratios or recurrent shell entities. Container tracking systems and electronic bills of lading improve traceability. Still, technology is only one link. Political will and interagency cooperation are equally vital. Trade-based laundering matters because it converts criminal proceeds into global liquidity without the spectacle of suitcases or counting rooms. It leverages the very instruments that power the international economy, documents, banks, ports, and uses them to move value invisibly. Detecting it requires reading the paper, knowing the markets, and following the cargo as relentlessly as law enforcement once followed a courier down the interstate. The next chapter will examine another channel where legitimate institutions were repurposed, unions and pension funds, their size and trust making them irresistible to those seeking clean capital. Chapter 6. Unions, pension funds, and institutional channels. By the 1960s, the mob no longer needed to smuggle cash across state lines to find legitimacy. It had found a cleaner, quieter partner: organized labor. Unions represented millions of working Americans, from truck drivers to hotel workers, and their pension funds held billions of dollars in deferred wages. These funds were designed to protect retirements. Instead, they became one of the most lucrative channels for laundering criminal money and financing mob-controlled ventures. At the center stood the Teamsters Central States Pension Fund, headquartered in Chicago. By the mid-1960s, it controlled more than $1 billion in assets, a staggering sum at the time. The fund's board was dominated by allies of Teamsters President Jimmy Hoffa, and its financial advisor Alan Dorfman acted as the gatekeeper for loans. Dorfman, the son of a Chicago outfit associate, had connections that extended deep into both legitimate business and organized crime. The mechanism was simple, elegant, and devastatingly effective. Developers, often frontmen or intermediaries with mob backing, applied for loans to build casinos, hotels, and commercial real estate. The loans were approved through channels that appeared legitimate, with paperwork, collateral, and repayment schedules. But the recipients often had mob affiliations, and the projects served dual purposes: profit and laundering. The Teamsters loans became the lifeblood of Las Vegas expansion in the 1960s and 1970s. Casinos like the Dunes, the Aladdin, the Fremont, and the Stardust received millions in Teamster-backed financing. On paper, these were sound investments, hospitality ventures in a booming city. In reality, they offered the perfect laundering cycle. Mob-controlled construction firms handled the building. Skimmed or illicit cash was mixed with legitimate loans, and casino profits, once washed through corporate structures, reappeared as lawful income. Alan Dorfman was the pivotal facilitator. He structured deals, smoothed approvals, and reassured pension trustees that the loans were secure. He also received consulting fees and kickbacks, ensuring personal loyalty from both mob figures and union officials. Investigators later uncovered evidence that Dorfman's approvals often coincided with bribes or political favors. His partnership with Hoffa was transactional. Hoffa wanted political and financial leverage. Dorfman wanted profit and protection. The oversight system was porous. Pension funds were nominally governed by fiduciary boards, but in practice, few trustees understood the loan's complexities. Regulations were vague, audits minimal, and enforcement nearly non-existent. The U.S. Department of Labor lacked the authority to scrutinize investment decisions in detail. As long as repayments were made, at least on paper, the loans appeared legitimate. This created a cycle of apparent legitimacy. Pension money flowed into development loans. The developers, often mob-linked, paid contractors and vendors connected to the outfit, and the returns were repaid to the fund. On paper, it was a sound, profitable investment. In reality, it was a closed circuit of influence, profit, and concealment. One of the most striking cases was the financing of the Stardust Hotel and Casino, whose Teamster-backed loans were later tied to skimming operations run by Midwest crime families. The money that built the casino came from union pensions. The money skimmed off the top was couriered back to Chicago, Kansas City, and Milwaukee, completing the circle between illicit and legitimate economies. When law enforcement finally began unraveling the connections, it wasn't a single event but a mosaic of investigations. The FBI's Las Vegas strike force traced Teamster-funded projects back to mob-controlled construction companies. Financial auditors discovered that loan repayments were being made irregularly, sometimes through shell entities, sometimes with inflated collateral. The Justice Department's Organized Crime and Racketeering section began issuing subpoenas, leading to a cascade of revelations about Dorfman's role and the fund's vulnerabilities. In 1981, Alan Dorfman was convicted of attempting to bribe a U.S. senator. Before he could testify further, he was assassinated in a Chicago parking lot in January 1983, shot 3 times in the head. His death silenced one of the most knowledgeable intermediaries between the mob and institutional finance. The ethical implications were profound. Workers' pensions, the hard-earned security of truck drivers, warehousemen, and laborers, had been weaponized to enrich organized crime. The fiduciary duty to protect retirees had been inverted into a mechanism for concealing illicit profits. The Employee Retirement Income Security Act, ERISA, of 1974 was Congress's response. ERISA imposed stricter fiduciary standards, required independent audits, and empowered federal agencies to investigate pension investments. For the first time, trustees faced personal liability for imprudent or conflicted decisions. But reform came slowly, and enforcement lagged behind the ingenuity of financial manipulation. Even after ERISA, the influence networks persisted. Front men and investment advisors found new ways to skirt oversight, using private placements, joint ventures, and limited partnerships to conceal the ultimate beneficiaries. Yet the Teamsters Fund, once the backbone of mob finance, came under federal supervision. In 1982, the Department of Labor placed the Central States Pension Fund under tight monitoring, effectively ending its role as a mob-controlled capital source. The consequences rippled outward. The mob lost its most reliable institutional bank. Developers who depended on easy loans turned to offshore finance and private lenders. The federal government's control of the Teamsters Fund marked a turning point, the beginning of the end for the era when organized crime could tap billions in legitimate capital with a single signature. But the legacy of that system remains a warning about the fragility of institutional trust. The Union Hall and the casino counting room, two worlds that seemed far apart, were linked by the same flow of money and the same rationalization. It's just business. For the mob, pensions were never about retirement. They were about access to capital, to legitimacy, to power. And for a time, it worked flawlessly. The money was clean, the projects gleamed under desert sun, and no one asked whose hands had guided the ink on the loan documents. When the Teamsters pipeline finally closed, organized crime adapted. The next frontier was less tangible but even more lucrative, the world of securities and markets, where numbers replaced cash and manipulation could happen in milliseconds. Chapter 7. Real estate and cash-intensive businesses, from nightclubs to construction. Real estate turns cash into permanence. Buy a building with illicit cash, collect rent, claim depreciation, and years later sell it as legitimate capital. The money has been reborn. The method is straightforward. Acquire assets that absorb large sums of money and produce plausible revenue streams. Hotels, motels, restaurants, nightclubs, car dealerships, vending companies, and strip clubs all accept high volumes of cash and therefore make ideal layering points. These businesses generate legitimate receipts that can be used to justify deposits, payrolls, and supplier payments. Tactically, organized crime used a sequence of moves designed to hide origin and manufacture legitimacy. First, purchase. A property is bought either outright with converted instruments or via mortgage financed by a willing lender. Second, concealment. Ownership is placed in nominee names, holding companies, or trusts to mask beneficial owners. Third, integration. The business reports elevated cash receipts, pays wages, and writes checks to vendors, turning dirty cash into documented operating revenue. Fourth, enhancement. Renovations, inflated contractor invoices, or phony franchise deals create large, paper-traceable expenses that justify subsequent loans and transfers. Fifth, realization. Properties are flipped or refinanced, generating capital gains or loan proceeds that appear to come from legitimate asset appreciation. Nominee owners and straw purchasers were critical tradecraft. A straw buyer appears legally as the purchaser, but acts at the direction of the true owner. Nominee directors sit on corporate paperwork, while the beneficial owner remains hidden behind layers of entities. These techniques prevent title searches from immediately revealing who benefits economically from a property. Inflated contractor payments were a favorite tactic. A construction company affiliated with or controlled by the same network would submit invoices far above market rates. The excess cash flowed back to the criminal organization as contractor profit, disguised as legitimate payments. Those payments could then be redistributed as wages, dividends, or purported supplier fees that legitimized prior deposits. Car dealerships and cash-intensive retail were particularly useful. Dealerships accept trade-ins and cash down payments, and they handle financing paperwork, that can convert physical dollars into bank credit. Vending and parking operations provided continual micro-cash flows that proved useful for smoothing deposit anomalies across many accounts and locations. Historic practice shows the scale and persistence of these tactics. From the mid-20th century onward, criminal investors bought motels and small casino properties, invested in nightclubs and restaurants, and used those venues to justify large cash movements. Bugsy Siegel's early nightclub and Flamingo investments exemplify how entertainment and hospitality could be combined with underworld capital to create visible businesses from secret funds. Later decades saw similar patterns. Family-controlled hotel investments and trucking companies that serviced casino supply chains often served dual purposes: legitimate commerce and cash absorption. Financing details matter. Mortgages and commercial loans could legitimize an initial purchase when banks were willing to lend against an asset's appraised value. Complicit lenders, negligent underwriters, or loosely regulated community banks sometimes provided credit without rigorous source of fund checks. Loan proceeds could then be used to pay off previous illicitly funded advances, creating a veneer of bank-issued legitimacy. Where direct bank loans were risky, other mechanisms appeared: seller carrybacks, private placements, and loans routed through seemingly unrelated companies. A property could be purchased by a shell company that then borrowed from another shell entity. The lender's identity might be an offshore trust, making domestic investigators' job more difficult. Refinancing allowed criminals to extract clean mortgage proceeds against an asset whose nominal equity had been built from laundered capital. Investigators respond with paper and provenance. Title searches trace layers of ownership, revealing chains of shell corporations and nominee names. Forensic accountants compare declared revenues to industry benchmarks, flagging restaurants or motels, reporting abnormal daily receipts for their size and market. Suspicious activity reports, SARs, created under banking regulations, provide a mechanism to escalate odd deposit patterns to law enforcement. Tracing capital improvements is another forensic avenue. Large renovations paid for in cash or via affiliated contractors often leave a transactional trail: materials purchases, subcontractor payments, and permits. When investigators compare the scale of improvements to declared business performance, inconsistencies become evidence. In successful prosecutions, prosecutors used contractor invoices, payroll records, and supplier receipts to connect reported business activity back to suspicious cash flows. Title insurance records and escrow documents have proven decisive. Where a recorded deed shows a nominee company, but escrow wire records or lender documents point to an offshore account, the discrepancy raises a red flag. Investigators subpoena bank records and cross-reference payments with construction draws, revealing rounds of circular payments between related entities. The human element remains the weakest link. Employees, small-time managers, or complicit accountants who handle daily deposits can be flipped as witnesses. A single teller or bookkeeper who keeps inconsistent records or who testifies about cash pickups can collapse a paper structure built to appear airtight. Regulatory tools tightened over time. The Bank Secrecy Act, SAR requirements, and enhanced real estate closing documentation rules increased scrutiny. Title companies and lenders implement anti-money laundering (AML) checks, and beneficial ownership rules now force greater disclosure about who truly controls an entity. But enforcement is resource-intensive. Unpicking layers of nominees, offshore trusts, and forged invoices requires time, cross-border cooperation, and specialist forensics. Real estate laundering is powerful because it yields durable results: buildings that appreciate, rental income that endures, and visible businesses that mask prior criminality. It is also risky, because legitimacy depends on records. Follow the paperwork, and the facade often unravels. Follow human witnesses, and the structure collapses faster. In practice, organized crime blended these two realities, paper and people, to convert the ephemeral value of suitcases into structures that shaped cities: hotels that stood on laundered foundation, restaurants that accepted illicit receipts, and developments whose loans once flowed from pension funds and shadowy accounts. The technique built permanence from crime, and dismantling it required both financial forensics and human testimony, two tools law enforcement would wield with increasing effect in the decades to come. Chapter 8. Securities, markets, and financial instruments. From penny stocks to junk bonds. The stock market is paper and perception. Where cash and concrete once laundered value, the market offered speed, scale, and plausibility. Give illicit proceeds a seat on a trading blotter, and they could become investment returns in days rather than years. Pump and dump is the archetype. Take a thinly traded small-cap company with few shares in public hands. Create demand through phone banks, newsletters, and introductions until the price rises. At the peak, insiders sell into the buying frenzy. Retail buyers are left with worthless float. The operators walk away with cash that now looks like proceeds from legitimate stock sales. Boiler rooms were the engine, rooms full of brokers, headsets, and scripts called retail investors day and night. Salesmen promised insider tips, guaranteed gains, and urgent windows of opportunity. On the ticker, a stock moved on volume engineered by orchestrated buying, often through related brokerage accounts or offshore nominees. Offshore accounts accepted the proceeds. Domestic shell accounts converted them into checks that re-entered the legitimate financial system. Mechanically, manipulation used a menu of techniques. A fake IPO or a reverse merger could create a publicly tradable shell overnight. The float, the number of shares freely tradable, was carefully controlled by insiders who held most shares in tight wallets. Wash trades moved volume without real change in economic ownership, creating the illusion of liquidity. Layering used multiple brokerage accounts, sometimes across jurisdictions, to move sales and buys in patterns that obscured the source of funds. Nominee accounts and offshore custodians hid beneficial ownership while providing ready conversion points for proceeds. The 1980s saw a proliferation of these schemes. Small brokerage firms cropped up in strip malls and telephone rooms, pressuring inexperienced brokers to chase quick commissions. Firms like Stratton Oakmont became infamous for their pump and dump operations and for selling the dream of fast money to ordinary investors. Many brokers and firms were later charged with securities fraud. Investigations revealed that some of these small-cap networks intersected with organized crime finance, either through direct investment, protection arrangements, or the use of mob-linked nominees to accept proceeds offshore. Those intersections turned what looked like a street scam into an institutionalized money movement channel. Markets offered additional laundering vectors as criminals moved beyond penny stocks. Junk bonds in the 1980s provided cheap, high-yield capital for aggressive corporate takeovers and leveraged buyouts. The same structures that financed hostile acquisitions could absorb large sums. Private placements, underwritten debt, and syndicated loans created complex paperwork and many hands through which money could be routed. A private placement could accept an investment from an offshore vehicle. The capital would be used for corporate operations, debt reduction, or equity purchases, producing apparent legal returns to the original source. The evolution continued into opaque investment vehicles, limited partnerships, hedge funds with lax disclosure, and private equity structures that pooled capital privately, often with minimal regulatory filing. These vehicles layered anonymity and diversified risk, useful attributes for someone seeking to integrate illicit capital into legitimate markets. A criminal investor could become a limited partner in a fund. Distributions later flowed as capital gains, carried interest, or management fees, all of which carried the appearance of lawful profit. Law enforcement adapted but faced unique challenges. Securities manipulation leaves paper, but it also creates plausible deniability. Trades occur, counterparties exist, and losses are built into the market's fabric. Proving intent required not just suspicious trading patterns, but corroborating evidence. Phone recordings, internal emails, bank transfers, and witness testimony. The Securities and Exchange Commission, SEC, and the Department of Justice increasingly coordinated with the FBI to combine market forensics with criminal intelligence. Operation Uptick is the emblematic response. Launched in the 1990s, it targeted organized crime infiltration of brokerages and penny stock manipulation. Wiretaps, undercover agents, and cooperating brokers produced a mosaic of evidence showing how mob networks used brokerages as laundromats, moving illicit proceeds through controlled trades and offshore accounts. Dozens of arrests, indictments, and asset seizures followed, and regulators revoked licenses of complicit brokers and firms. Regulatory reforms followed the prosecutions. Enhanced surveillance algorithms flagged suspicious trade patterns, sudden spikes in volume, repeated wash trades among a tight set of accounts, or atypical routing to offshore custodians. FINRA, then NASD, and the SEC imposed tighter anti-money laundering obligations on broker-dealers, requiring customer due diligence and monitoring of unusual transaction activity. Banks and brokerages increased their KYC, Know Your Customer checks, and suspicious activity reports, SARs, became a routine part of the compliance ecosystem. But markets adapt as quickly as regulators. Criminals shifted to more sophisticated instruments, used derivatives to obscure exposure, and spread trades across time and geography to evade algorithmic detection. Private placements in lightly regulated jurisdictions, nominee accounts in trusted brokerages, and the use of professional facilitators, lawyers and accountants, to structure transactions complicated detection. When enforcement closed one channel, another opened. The dynamic between criminal innovation and regulatory response became a continuing arms race. Securities laundering also carried different psychological advantages for criminals. Money invested in markets could grow legitimately. A successful manipulation produced not only a cleaned balance but potential real profit. More importantly, market returns provided an explanation. The money was not from the casino, it was returns from an investment. That narrative proved persuasive in legal and public contexts, making prosecutions harder and settlements more politically palatable. Historic prosecutions set precedents. Courts treated coordinated market manipulation and money movement schemes as crimes when prosecutors could show concerted intent to defraud investors or to disguise the source of funds. Fines and jail sentences followed for brokers and operators, but the sheer scope of markets meant isolated enforcement did not eradicate the practice. Preventive tools, education for retail investors, stricter disclosure rules, and better cross-border cooperation became as important as reactive prosecutions. By the end of the 20th century, the laundering model had shifted yet again, from suitcases to securities, from counting rooms to trading rooms, and from visible muscle to invisible algorithms. Criminal actors discovered that finance could be both a laundromat and a growth engine. The result was a more dangerous and complex threat, one that required forensic accountants, international regulators, and digital surveillance to combat. The story of market laundering is a study in conversion. Risk becomes a trade becomes a return, and the return becomes justification. Follow the trades, and you find the hands that move the money. Follow the algorithms and offshore custodians, and you often find the same old motive, profit, dressed now in ticker tape and confirmations. Chapter 9. Professional facilitators, lawyers, accountants, and fixers. Every laundering system, no matter how elaborate, eventually meets paper and procedure, and that's where the professionals enter. Behind every shell company, offshore trust, or real estate deal, someone drafts the documents, signs the filings, and assures the bank that everything is in order. Lawyers, accountants, bankers, and real estate closers became the indispensable clean hands of dirty money. They didn't pull triggers or smuggle cash across borders, but they built the architecture that made it all look legitimate. These facilitators operated in the gray space between legality and complicity. A lawyer might set up a holding company for asset protection. An accountant might structure intercompany loans to optimize tax liability. But in practice, those same structures could disguise the source of criminal proceeds. Client confidentiality became a shield, attorney-client privilege a fortress. Know Your Customer became, don't ask too much. The tactics were subtle but consistent. Contracts justified transfers that had no real business purpose, consulting agreements, licensing fees, or advisory retainers that masked money movement. Complex corporate webs layered ownership across jurisdictions, a Delaware LLC owned by a Cayman trust managed by a Swiss foundation. Bankers opened accounts for shell entities, relying on letters from respected law firms to vouch for beneficial owners whose identities were never truly verified. Accountants booked incoming cash as revenue, then expensed it through service agreements with offshore subsidiaries, cycling it clean. Several cases made the hidden visible. In the 1980s and 90s, prosecutors exposed lawyers and accountants who helped drug traffickers and mob figures hide assets through offshore vehicles. Alan Dorfman, the Teamsters' financial advisor, blurred fiduciary duty with criminal collaboration, channeling pension funds into mob-backed loans and real estate deals. In 2016, the Panama Papers leak revealed how Mossack Fonseca, a Panamanian law firm, helped clients worldwide create opaque companies that obscured ownership and facilitated evasion. In the United States, multiple law partners and accountants were indicted for wiring cartel and corruption proceeds under the guise of client transactions, each claiming they relied on client representations. Regulators responded by tightening the net. Anti-money laundering, AML, and countering the financing of terrorism, CFT frameworks extended to the professional class. Law societies, bar associations, and accounting boards adopted rules requiring due diligence when handling client funds or forming entities. Know Your Customer evolved into Know Your Client. Suspicious activity reporting obligations were introduced for designated non-financial professions, lawyers, accountants, notaries, and real estate agents in many jurisdictions. Yet enforcement remains delicate. Attorney-client privilege still limits disclosure, and ethical codes vary by country. Some professionals knowingly exploit these gaps, while others are simply willfully blind, preferring not to ask where the money truly comes from. The result is a paradox. The people trained to detect risk and uphold legality often become its best camouflage. Professional facilitators are the connective tissue between crime and commerce. They lend language, structure, and credibility to illicit capital. Without them, laundering remains crude. With them, it becomes indistinguishable from finance itself. As one investigator put it, the mob didn't need to learn accounting. The accountants came to them. Their legacy is not just complicity, but credibility. The transformation of crime into compliance through signature, seal, and silence. Chapter 10. The Countermeasures. How the Feds Caught Up Law Changes the Geometry of Crime. For decades, criminals exploited legal blind spots. Then lawmakers closed lanes and investigators learned to read money the way they once read faces. The legal scaffolding began to take shape in the 1970s. On November 26, 1970, Congress enacted the Bank Secrecy Act, demanding records and laying the first statutory line that banks must report large cash transactions. That law created currency transaction reports, CTRs, and started to make once invisible deposits visible to investigators. RICO, passed in 1970 as well, gave prosecutors a structural weapon. Instead of charging isolated crimes, they could indict enterprises and demonstrate patterns across years and jurisdictions. RICO turned many small acts into a prosecutable conspiracy. Investigative tools matured in parallel with statutes. Wiretaps, long used in violent crime probes, made a decisive leap into financial cases, capturing conversations about courier runs, shell companies, and skim amounts. Undercover operations infiltrated brokerages, counting rooms, and courier rings. Financial forensics developed into a discipline. Auditors who could reconcile a company's declared revenue with industry benchmarks, trace correspondent banking entries, and follow MT-103 SWIFT messages linking offshore transfers. The IRS's Criminal Investigation Division brought tax law to bear on hidden wealth. When ledgers failed to explain a lifestyle, tax charges often filled the gap. The SEC and FINRA joined the fight on markets, tracking suspicious trade patterns and complicit brokerages. The FBI, IRS, and SEC began to form joint task forces, coordinated teams that merged human intelligence, financial data, and legal strategy. International cooperation evolved too. Mutual Legal Assistance Treaties, MLATs, created formal processes to obtain foreign bank records. They were slow and bureaucratic, but they provided a legal path to Swiss ledgers, Panamanian incorporations, and Caribbean trust documents. By the late 1980s and 1990s, the Financial Action Task Force, FATF, pushed countries towards common AML standards, urging customer due diligence and suspicious activity reporting. Those global norms made secrecy jurisdictions less hospitable over time. Operationally, the feds learned to follow the money as a composite signal. A single deposit no longer mattered as much as a pattern. Repeated small deposits across branches, coincident insurance claims and vendor invoices, or matching payments between a shell company and an offshore trust. Analysts built link charts, then fed them to prosecutors who could assemble RICO predicates into indictable enterprises. Operation Strawman exemplified the method. Launched in the late 1970s and running into the 1980s, it targeted the Las Vegas skim network and the courier and counting room infrastructures that fed Midwest families. Wiretaps, informants like Frank Collada, and coordinated surveillance produced indictments against managers and outfit figures, exposing how casino cash became off-book currency for organized crime. Operation Uptick marked another evolution. In the 1990s, law enforcement turned to the securities world, investigating brokerages and penny stock frauds that served as laundering channels. Undercover brokers and cooperating witnesses revealed how boiler rooms, offshore nominees, and manipulated floats moved illicit proceeds into apparently legitimate market returns. Uptick blended SEC market forensics with FBI criminal intelligence to indict brokers, organized crime associates, and money movers. High-profile convictions followed. In 1986, Joseph Ayupa and John Cerrone, leaders associated with Kansas City and Chicago operations, were convicted in connection with casino skimming, demonstrating that the combination of wiretaps, subpoenas, and cooperating witnesses could topple top figures. Later prosecutions, Operation Family Secrets in the 2000s among them, used accumulated wiretap transcripts, witness testimony, and financial records to reconstruct decades of criminal enterprise. Technology accelerated capability. Databases allowed seizure of phone records, motel logs, and rental contracts and the immediate cross-referencing of names and numbers. Data analytics flagged anomalous banking behavior. Pattern recognition pointed investigators to suspect corridors. Electronic subpoenas forced banks to produce records that once required months of diplomatic negotiation, yet enforcement faced paradoxes and limits. Every reform generated adaptation. When CTRs and SARs made cash movements visible, criminals layered. Shells, offshore accounts, and trade-based laundering proliferated. When markets were policed more tightly, laundering migrated into private placements and opaque funds. The cat-and-mouse game became institutionalized. Law tightened. Methods evolved. Law tightened again. Modern parallels underscore the continuity. The Panama Papers leak of 2016 revealed the same toolkit on a commercial scale: anonymous entities, nominee directors, and offshore structures tailored to mask ownership. The tactics were not new. They were refinements of decades-old mob tradecraft, applied by new actors and enabled by modern globalization. Regulatory reforms reduced some corridors. The USA Patriot Act after 2001 expanded AML requirements, strengthened MLAT processes, and elevated interagency coordination. The FATF's standards pressured secrecy jurisdictions to adopt transparency measures. Banks improved KYC protocols, and professional services increasingly faced AML obligations. But enforcement remained resource-intensive. Tracing a complex laundering circuit still requires subpoenas, international cooperation, forensic accounting, and witness cooperation, resources not guaranteed in every case. The countermeasures changed the risk calculus for organized criminals. Brute force and visible control no longer guaranteed survival. Invisibility and financial sophistication became the new armor. Some criminal groups shifted tactics entirely, favoring white-collar stealth over street violence, while others maintained both capacities. The closing contrast is stark and instructive. Old-style mobdom relied on muscle, threats, and counting rooms. It could be toppled by informants, wiretaps, and coordinated indictments. Modern money laundering prefers anonymity, legal veneer, and financial complexity. It resists spectacle and demands specialized detective work. Both use the same playbook's logic: obfuscate origin, create plausible commercial narratives, and place distance between crime and beneficiary. But one does it with fists and couriers, the other with ledgers and layers. Ultimately, the federal response proved durable, not because it matched every new trick instantly, but because it changed the institutional environment. Laws required records, regulators demanded checks, and prosecutors could pursue enterprises, not just acts. That combination raised the cost of laundering, shrank safe havens, and turned previously comfortable trades into prosecutable networks. Follow the money now, and you see not only a trail, but the scaffold of law built to trace it. The mob's methods evolved, but so did the world's ability to read the paper, and the ledger increasingly tells the truth.